Here we go. Make sure you let me know if you can hear me all right. Sound is always an issue or a concern. Should be starting in about a minute and a half to 2 minutes. Let me know if you can hear. Chat, 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 chat. As soon as they start talking, I'll turn on the desktop audio. All right, Cabo. Be sure to chime in the chat if you hear what I'm saying. I do these checks just to make sure that it's working well before the...
Thank you for standing by. My name is Bailey, and I will be your conference operator today.
All right, they're about to start, so let me know when you can hear what they're saying.
2025 earnings conference call. All lines have been placed on mute to prevent any background noise during this 60-minute call. After the speaker's remarks, there will be a question and answer session. If you would like to ask a question during this time, simply press star followed by the number 1 on your telephone keypad. If you would like to withdraw your question, press star and 1 again. Thank you. I would now like to turn the call over to Charles Lambert, Senior Vice President. Please go ahead.
Good morning, and welcome to the Medical Properties Trust conference call to discuss our first quarter 2025 financial results. With me today are Edward K. Aldag, Jr., Chairman, President, and Chief Executive Officer of the company, Stephen Hamner, Executive Vice President and Chief Financial Officer, Kevin Hanna, Senior Vice President, Controller, and Chief Accounting Officer, Rosa Hooper, Senior Vice President of Operations and Secretary, and Jason Fry, Managing Director, Asset Management and Underwriting. Our press release was distributed this morning and furnished on Form 8-K with the Securities and Exchange Commission. If you did not receive a copy, it is available on our website at medicalpropertiestrust.com in the Investor Relations section. Additionally, we're hosting a live webcast of today's call, which you can access in that same section. During the course of this call, we will make projections and certain other statements that may be considered forward-looking statements within the meaning of the Private Securities Litigation Reform Act of 1995. These forward-looking statements are subject to known and unknown risks, uncertainties, and other factors that may cause our financial results and future events to differ materially from those expressed in or underlying such forward-looking statements. We refer you to the company's reports filed with the Securities and Exchange Commission for a discussion of the factors that could cause the company's actual results or future events to differ materially from those expressed in this call. The information being provided today is as of this date only, and except as required by the federal securities laws, the company does not undertake a duty to update any such information. In addition, during the course of the conference call, we will describe certain non-GAAP financial measures which should be considered in addition to, and not in lieu of, comparable GAAP financial measures. Please note that in our press release, Medical Properties Trust has reconciled all non-GAAP financial measures to the most directly comparable GAAP measures in accordance with Reg G requirements. You can also refer to our website at medicalpropertiestrust.com for the most directly comparable financial measures and related reconciliations. I will now turn the call over to our Chief Executive Officer, Ed Aldag.
Thank you, Charles, and thanks to all of you for joining us this morning on our first quarter 2025 earnings call. I'm pleased to be joined again today by Steve, Kevin, Rosa, and Jason. But before you hear from the rest of the team, I'll spend a few minutes discussing the state of the market and a few recent strategic updates. Beginning with the broader market environment, it's important to note that despite all of the noise surrounding the macroeconomy, healthcare has historically proven to be one of the most recession-resistant industries. Across our portfolio, operators continue to report strong results with increasing volumes and steady coverage. Further, any concerns surrounding the impacts of tariffs or proposed funding changes only serve to reinforce the importance of MPT's business model. When hospitals need access to affordable capital solutions that enhance their financial flexibility and operational agility, that's where we come in. We empower operators to replace expensive debt solutions, immediately unlock 100% of the value of their real estate, and redirect those funds into patient care. And we are confident in our ability to continue playing that role in this critical economic environment. Turning to a few updates from the quarter, in February, we issued more than $2.5 billion of 7-year secured bonds at a blended coupon rate of approximately 7.8%, strengthening our balance sheet and providing sufficient liquidity to cover all debt maturities through 2026. As Rosa will discuss in more detail shortly, our new portfolio of tenants continues to ramp operations at facilities around the country. Broadly speaking, we remain highly encouraged by the volume improvements being reported across these locations, as well as the steps these new operators are taking to upgrade facilities. And importantly, all new operators, except for Insight, who owed less than $100,000, were current on rent through the first quarter. In Ohio, Insight Health had been making considerable progress, turning around performance at 2 facilities in Trumbull County. However, those efforts were interrupted by disputes between Steward Healthcare's advisors and Insight regarding the distribution of cash collections from Insight's revenue under the terms of the Transition Services Agreement. We're working with Insight and government officials to explore all viable solutions to restore full operations at these facilities as soon as possible. A word briefly on Prospect before turning it over to Rosa. in line with the terms of our global settlement agreement with Prospect and its other creditors that the bankruptcy court approved in March. Prospect and its advisors are in the process of marketing the Prospect assets. With the progress of our new operators are making across most markets, the steady contributions from our stabilized portfolio, we remain confident in our ability to reach total annualized cash rent of more than $1 billion once our new tenants are fully ramped. As we continue with this progress, we look forward to opportunities for accretive growth and increasing shareholders' return. Rosa?
Thank you, Ed. Turning now to some of the highlights across our portfolio. Overall, operator trends remain largely consistent with our observations over the past few quarters. As publicly traded operators have recently reported, in the first quarter of 2025, hospitals have produced strong revenues driven by reimbursement rate increases and admission trends. Within our portfolio, we continue to see strong growth in admissions and rate improvements. And on a trailing 12-month basis, we saw an uptick in year-over-year EBITDARM coverage across asset types, driven by improved volumes and strategic expense management. I'll begin with the new tenants in our transitional portfolio, with cash rents ramping through the fourth quarter of 2026. HSA, which operates 8 hospitals in South Florida, Texas, and Louisiana, commenced rent payments as scheduled in March. Performance has trended up, particularly in South Florida, driven by top-line growth on higher volumes. In Louisiana and Texas, HSA remains focused on expanding inpatient capacity, re-engaging key physicians, and improving operational efficiency. Honor Health, which operates in the Phoenix metro area, remains engaged in enhancing physician alignment in the market and upgrading facilities ahead of anticipated volume recovery. Honor is executing a CapEx strategy for 2025 that includes $60 million of self-funded improvements spread across its new facilities. Forum Health, which operates 2 facilities in West Texas, has committed to recruiting physicians and staff to recapture volumes, ramping up new service lines, and upgrading facilities. In March, Forum also finalized an agreement to assume ownership of Steward's remaining IT and revenue cycle transition service agreements. College Health is operating 1 MPT behavioral health facility in Phoenix. They have been ramping up capacity at the facility and now have a license for 127 beds. With 30 beds open so far, they are actively adding beds on a regular basis and expect to be at full capacity within the next few months. Finally, Tenor Health took over operations at Sharon Regional in Pennsylvania and reopened the facility in March. Tenor is now executing an 18-month plan to fully stabilize the facility, and to facilitate this plan, recently secured new financing from a local community entity. Turning now to our more established portfolio of operators and beginning with Europe. In the UK, 3 of the operators in MPT's portfolio have been nominated for Health Investors Private Hospital Group of the Year: Circle Health, Priory, and Ramsay. Circle Health continues to benefit from increased private medical insurance utilization. To capitalize on these market tailwinds, Circle is investing in innovative technologies such as robotics and AI. And Circle continues to report strong performance driven by increasing surgical volumes and patient acuity as more complex cases are being addressed in the private sector. The need for mental health care services has never been greater within the UK, and Priory, the largest independent mental health care provider in the UK, has maintained steady performance based on strong reimbursement trends and increased patient acuity. Turning to Priory's parent company, Median, these German assets have performed well through Q4 2024. This solid performance is largely attributable to an improving reimbursement rate environment and increasing occupancy trends. Swiss Medical's performance has benefited from a combination of continued cost optimization efforts and top-line growth, driving high single-digit EBITDA growth. With the planned integration of recent acquisitions, Swiss Medical's consolidated revenues are expected to increase by approximately 100 million Swiss francs in 2025. And in January 2025, Swiss Medical continued to grow its integrated care model with the addition of a second care region with 10 medical centers. In April, MPT invested approximately 50 million Swiss francs in the Infracore joint venture in Switzerland to facilitate the platform's acquisition of a strategically valuable general acute facility. Turning to the U.S., Ernest Health's consolidated EBITDARM coverage remains excellent at 2.1 times. Ernest's legacy IRFs are performing very well, and newer IRF developments are moving closer to fully ramped capacity. Given the success of its first inpatient rehab unit at the Provo LTAC, Ernest is pursuing plans to open 2 more inpatient rehab units at the Post Falls and Billings LTACs in 2025. LifePoint Health continues to report strong top-line revenue growth driven by increased admissions, particularly at Conemaugh Memorial, where trailing 12-month admissions increased 17% year over year. LifePoint Behavioral reported another quarter of consistent operating performance with higher admissions growth year over year. In 2025, LifePoint Behavioral will remain focused on increasing outpatient volumes to drive increased revenues. Finally, MPT owns 3 hospitals operated by Surgery Partners. These facilities have performed exceptionally well, with combined coverage greater than 7 times. In closing, MPT is clearly well-positioned to benefit from enhanced cash flows across a better diversified portfolio than ever before. With our stabilized portfolio producing steady or improving performance and our transitional portfolio ramping as expected, we are confident in our ability to create value for shareholders moving forward. Kevin?
Thank you, Rosa. This morning, we reported a GAAP net loss of 20 cents per share and normalized FFO of positive 14 cents per share for the first quarter of 2025. It is worth pointing out that first quarter net loss and normalized FFO, when compared to the fourth quarter of 24, were affected by the partial quarter impact of our February debt refinancing transactions, the normalization of cash rent payments from a small tenant who made a one-time catch-up payment of $10 million in the fourth quarter, and higher stock compensation expense. We expect the second quarter normalized FFO will be reduced by an additional approximately 2 cents per share due to the full previously projected quarterly impact of higher interest expense resulting from our refinancing transactions. The increased stock compensation expense results from a change in the fair market value of 2024 performance-based equity compensation, of which no shares have been vested. In fact, none of these shares will ever vest unless the market price of our stock exceeds $7 for 20 consecutive days. During the quarter, we recorded approximately $73 million in impairments and fair market value adjustments to our investments in Prospect, real estate in Connecticut, and in PHP. These adjustments were made according to third-party appraisals and approved restructuring terms. Actual recoveries may ultimately differ from these book values. Further, we impaired our mortgage investments in Colombia by approximately $11 million as the government continues to limit reimbursement to hospitals. Normalized FFO was also adjusted for an approximate $12 million negative fair value adjustment related to marketable securities, such as our investment in Aevis. With that, I will now hand the call over to Steve.
Thank you, Kevin. I will just make a couple of brief comments that basically reiterate our near-term perspective. I'll not go through the details of the February secured notes offerings, except to point out again that it was a significant culmination of 2 years of carefully executed transactions designed to reduce debt, extend maturities, and provide liquidity, all at market valuations that demonstrate the resilience of well-underwritten hospital real estate and the long-term sustainability of our business model of net leased hospital real estate. But I will describe one detail of this refi. At quarter end, we thought it prudent to build some additional cushion for the covenant that measures our ratio of unencumbered assets to unsecured debt. At that time, we had not completed our evaluation of the need for impairments as of the quarter end, and we wanted this cushion in an abundance of caution. Drawing cash on a secured revolver has the effect of increasing that cushion. The amounts we borrowed on March 31 were fully repaid on April 1. We remain and expect to remain within all covenants required by the secured and unsecured notes and the revolving credit facility. So our focus is on our existing portfolio of hospital real estate that continues to perform in accordance with lease terms, including annual inflationary escalations. And over the remaining 3 quarters of 2025, cash rents solely from the former Steward facilities are scheduled to increase from the $4 million received in this first quarter to more than $23 million in the fourth. That's more than $90 million annualized. And investors can make their own estimates of an appropriate equity capitalization rate for that incremental revenue. And that incremental revenue is scheduled to continue growing to total contractual annual cash rents of $160 million from these hospitals by October 2026. The first quarter results, of course, include no revenue or other proceeds from any Prospect assets or from certain of our Colombian real estate assets, which have a book value of about $112 million. Any such revenue or proceeds will, of course, be available to further add to our operating and balance sheet strength. We're not in a position to predict these outcomes today, but it is important that with the balance sheet repositioning we have completed over the last couple of years, we have multiple options to continue to use the demonstrated value of our performing assets for further delevering and repositioning as we may decide. As we previously described, those options still include resolution of the Prospect assets through sales and retenanting, possible other asset sales, joint ventures, and other transactions to reposition and rationalize our equity value. And with our current level of near-term maturities and liquidity, we have the freedom to be patient, while even if we assume no external growth, our expected cash earnings escalate annually, and we can hope macroeconomic conditions stabilized. Lastly, as Ed emphasized, we are pleased with the operational performance that our new operators are achieving. This performance, along with the very public and widespread support of local, state, and federal government officials and healthcare advocates, yet again demonstrates the importance of and the demand for these infrastructure-like hospital assets. Because our underwriting is designed to identify hospitals that we believe are critically necessary to their communities. This performance and public support is what we expected. And from a financial perspective, MPT as landlord has gone above and beyond to demonstrate our long-term commitment to keeping these hospitals open. We have invested in the facilities, we have made working capital loans to facilitate the Steward transition, and we have agreed to lengthy periods where rent payments are not required. Along with our own efforts, the new operators are devoting time, effort, resources, and their own finances to serve patients across many spectrums of care. And we can point to government officials and representatives in Ohio and Pennsylvania who we see working out of public view on behalf of patients and employees in their own and even other jurisdictions. All of that is why we remain firm in our belief that these hospitals need to and will stay operating in their communities. Again, this is what we expected. What we did not expect, and what is virtually inexplicable to us, are the apparent roadblocks in front of these efforts to keep the hospitals open and operating. The managers of the Steward bankruptcy process, for example, have paid professional fees now approaching $400 million. They are collecting from Medicare, Medicaid, state reimbursement programs, and commercial insurers amounts for medical, surgical, and other treatment services that the new operators are providing to patients. Our tenant in 2 Ohio hospitals believes it is owed more than $20 million that has been collected by the bankrupt estate but not remitted to the operator. Most recently, another of the replacement operators was notified that the bankrupt estate is seeking to retain $55 million in Florida Medicaid supplemental funds that would not have been paid had not the new operator contributed approximately $30 million to the program in late December. These disputes are all apparently subject to defense by the professionals managing the Steward bankruptcy, and they are being addressed in bankruptcy court. Our point is that these new operators are diligently treating patients, even though substantial payments for these services are being withheld from them. Thankfully, we believe these operators will soon be able to bill and collect for themselves. Meanwhile, MPT has continued to cooperate with and support these local communities, including financially, while the Steward transition process finally unwinds. For example, during the first quarter, in order to accelerate this unwinding process, we agreed to repurchase certain real estate interest we had previously exchanged for value with a secured creditor. Along with funding another small operator obligation, this aggregates about $40 million. We're actually happy to have these assets back because we believe we will get much more value out of them than the secured lender could have. And with that, I will turn the call back to Bailey to queue any questions.
At this time, I would like to remind everyone, in order to ask a question, press star and then the number 1 on your telephone keypad. Please limit to 1 question and 1 follow-up. Your first question comes from the line of Michael Carroll with RBC Capital Markets. Please go ahead.
Yep, thanks. Steve, I wanted to follow up on your prepared remarks, your last 2 comments. Do you think that there's risk to the Steward transitioned assets, those new operators, and being able to have the rent ramp up versus what you expect, given your comments regarding the issues in the Steward bankruptcy process and them not being able to collect the payments that are potentially owed to them?
No, I don't think so for a couple of reasons. Number one, I pointed out the Ohio situation, and I think we had already described that, that's very limited in any case. It's $100,000 that went uncollected. That's all that went uncollected in the quarter. And my point really was that these operators are doing as well as they are in the face of the disruption and not being able to collect what they're actually billing. We are hopeful that the transition will be fully moved away from Steward, and it already is for some of the operators. But we think that will be complete in the very near future, and this issue will resolve going forward.
Okay, and then can you talk about the $40 million investment? Was that made during the quarter? What type of asset did you get back from that? And are you getting rent on that asset now, and or do you plan on selling that asset in the near term?
We did do it during the quarter. Those assets represent assets that were originally part of Steward campuses. For example, just as an example, a big piece of it is a parking lot. And the parking lot was not necessary for the hospital operations other than to have contractual access to parking, which the hospital did. The secured creditor to which we transferred rights to it well over a year ago was unable to market it and monetize it, really because it was still connected to and part of the hospital. And so we were very happy to be able to get that back, and frankly, we got it back at a significant discount to what the original transaction was, and it will remain part of and could be monetized as part of the hospital. That's a typical example.
The vast majority of those, Mike, we will collect rent on.
Okay. And then just last for me, were there any other investments that occurred in the quarter? I didn't see the supplemental section that highlight your investments in the stuff this time around, and your debt seemed a little bit higher than what I would have expected. So is there any other cash outflows that we should be aware of that kind of explain some of that?
We made a relatively modest investment in an additional hospital in Switzerland with Infracore.
Okay, so just that $40 million deal and the Infracore deal?
Yeah, and as part of the transition very early in the quarter, I think very early in January, we did add to the Florida operator working capital loan to the extent of $10 million.
Okay, thank you.
Your next question comes from the line of Georgi Dinkov with Mizuho Securities. Please go ahead.
Hi, this is Georgi on for Vikram. Can you just talk sort of what are you monitoring on the regulatory side and any potential Medicaid cuts? Like, what are your expectations in a scenario where you see some severe budget cuts?
Georgie, if you listen to our last earnings call, we welcomed some of those Medicare cuts. As you know, Medicare doesn't just cover reimbursement to hospitals. It's a very broad basket of items that we believe would be better served if it went to hospitals. So we at this point don't have any of our tenants that are nervous about any potential changes to Medicare or Medicaid.
Okay, and if I may squeeze a second question, do you expect to provide any loans to any of the operators? And do you currently have any tenants on your watch list that you're closely monitoring?
So we don't expect to make any loans. We don't have any situations where we think that would come up, and we currently don't have any operators on our watch list.
Great, thank you for taking my question.
Your next question comes from the line of John Kiligowski with Wells Fargo. Your line is open.
Good morning. Thank you. My question is just on two operators. You mentioned no operators on the watch list, but I know that there were a couple situations we were watching. There was an operator in Colombia dealing with some government holding back of reimbursement, and then there was another one that was 1% of assets that you had gotten $10 million for last quarter, but I think that was a one-time chunk. Could you give some color on how those processes are going?
So the 1% tenant, the $10 million was a catch-up in rent. They remain current on the rent schedule now. I actually spoke to the CEO of that operator yesterday, and they had their best quarter in a long time. So they believe they're very much on track. We believe their operations are back where they should be. From Colombia's standpoint, the hospitals in all of Colombia continue to perform well. There is a political fight trying to get some healthcare reforms by the current president, and he's using the reimbursement to their system as a way to help pressure the politicians there to go along with his reforms. We are not concerned about the long-term viability. We obviously are concerned about when they'll start getting full reimbursement from the government, but we think it's just a matter of time, not a matter of if.
Okay, thank you. And then maybe just on Prospect following the court approval, how do you expect that process to go, I guess, as far as timing is concerned?
So it's a little bit different, or a lot different, I should say, than the Steward process went. We and Prospect and the other creditors reached an agreement early in this process. We expect that we'll have the potential new tenants in the hospitals identified late May, early June, and then closing as soon as regulatory can happen after that.
All right. Thank you.
Your next question comes from the line of Omotayo Okusanya with Deutsche Bank. Your line is open.
Yes. Good morning, everyone. first of all, just a shout out to Rosa. I'm always impressed with all the details she gives in the operational overview. I always find that very helpful.
Us too, Tayo.
In terms of the cash ramp up for the transitional tenant, again, could you just give us an overview of how exactly that works? In terms of is the arrangement that they transfer kind of all the excess cash flow to kind of ramp up to that $40 million a quarter? Is there some type of set math of, based on how much they earned that quarter, how much they have to kind of pay you? Just trying to understand how that works.
Yeah, Tayo, it's actually a percentage of the rent, not based on revenue or on their income. For example, at the beginning, and each lease is slightly different. They go from 25 to 50 to 75 and to 100, and by the time that we get to 100% is
fourth quarter of
26.
Gotcha. Okay, so that's helpful. And then in terms of, again, at March 31st, the drawdown on the line to kind of make sure you guys were okay with the covenants. Just curious now that you've kind of settled in with the write downs, associated with Prospect. Is that something you would expect to occur again at the end of a quarter, or now that you kind of solidified what your write down numbers are, you kind of have much more sense of what your coverage is, and you may not have to do that going forward?
Well, in retrospect, Talia, we didn't have to do it even at the end of the quarter. Had we not made that drawdown, we still had sufficient, comfortable cushion, even had we not done it. The reason we did it, as I said in my remarks, was because we were still working on the impairment calculations, and as it turned out, as I say, we had plenty of room, even had we not done that. Kind of to answer your question, going forward, it's available to us. Banks are perfectly satisfied with it. It was the plan all along that this would give us, that type of cushion should we need it. But there's no expectation as we sit here today that we will or will not need it. It depends on a number of things, frankly.
That's helpful. Thank you.
Thank you, and I will now turn the call back over to Ed Aldag for closing remarks.
Haley, thank you very much. I do have an unplanned comment I'd like to make. Over the last year of walking through the Stewart bankruptcy, I've reflected on the different reactions and actions of the many different people involved. The bankruptcy process itself was obviously very painful. Those controlling the process didn't always have as their number one priority the patients or the communities. Some politicians use this as an opportunity to further their own political agendas, as opposed to finding ways that we could all work together for the best outcomes of each community affected. Steve has commented on the more than $100 million that MPT has put in voluntarily to help keep these hospitals open. But we haven't been alone in our fight to save these hospitals. And at the risk of inadvertently leaving someone out, let me do my best to call out some of the real heroes by name and some of those that I don't know their names. Let me start with Judge Marvin Isker and Judge Lopez of the Bankruptcy Court in Houston. They recognized that the process that was in place to find replacement operators for Stewart hospitals wasn't working. And in August of last year, Judge Isker invited me to Houston to look for a solution. He worked tirelessly to give MPT the opportunity to re-tenant these hospitals. He and we obviously didn't have much time starting in early September. He literally worked 24 hours a day to find a solution that Judge Lopez could approve. And then he worked with the parties for months to implement those solutions. So without Judge Isker and Judge Lopez, none of this would have been possible. I got to know Judge Isker well over a 5-month period of time. He's an outstanding person and a terrific mediator, and we appreciate all that he did for the people in all of the communities to ensure that these hospitals stayed open. In Pennsylvania, I worked night and day with Judge Isker and Deputy Attorney General Jim Donahue to find solutions in Sharon, Pennsylvania. Jim and Judge Isker and I spent many hours late into the night and the holidays working to do what we could for Sharon. State Senator Michelle Brooks reached out to me to find ways that we could work together to find funding for the hospital there in Sharon. I can tell you her commitment to that community is truly second to none, and her willingness to work with MPT was very much appreciated. In Ohio, I've gotten to know U.S. Senator Bernie Moreno. Senator Moreno reached out to me to work with MPT to find solutions for the two facilities there. Senator Moreno has been a breath of fresh air and a real pleasure to work with, and we both are working very hard to keep these two hospitals in Ohio open. In Florida, Texas, Arizona, and Arkansas, while I don't know the names of the state officials there, but without exception, the Attorney General offices, the Departments of Health, and others have truly been can-do people. People who jumped through hoops to work with us and Judge Isker to ensure their community hospitals stayed open. They offered help at every turn, not roadblocks. And I'm truly sorry I don't know their names to give them the credit they deserve. While there have been people with personal agendas in other states, people who haven't wanted to let a crisis pass without using it for their benefit, truly the vast majority of the people that I came in contact with during this whole process are the true unsung heroes, and it's been my honor to work with each and every one of them. We look forward to moving forward from this point, and again, we thank you all for being with us today, and if you have any additional questions, please don't hesitate to reach out to Tim and Drew. Thank you.
Ladies and gentlemen, that concludes today's call. Thank you for joining. You may now disconnect.
Well, that was something. No, by the way, I'm assuming anybody that pops in here late is going to ask if they mention anything about the dividend. I didn't hear anything regarding that, so yeah. So I guess we're going to have to wait for the board to meet and to discuss that to be able to know about the dividend. But yeah, I mean, there weren't really any surprises here, to be honest. So, yeah, not the most eventful earnings call, but also not a disaster. So, yeah, that's nice. Stock is up like a little bit still on the day. Yeah. I suppose tariffs could indirectly, obviously rent isn't tariffed and this is a landlord and their money comes from rent collections, but yeah, there is like a secondary thing where maybe the operators pay more for certain types of supplies or equipment that aren't manufactured here. Though I'm sure some are and some aren't. I don't know what the split is on, like, yeah, where do they produce like bandages, gauze, syringes, that kind of thing. How about like MRI machines and things like that? I don't know. Like, it would be interesting to see a breakdown of where all of those things are manufactured and how impacted they might be by tariffs. But yeah, at the end of the day, healthcare operators will eventually if the cost of bandages goes up by 20% or something, they'll pass that on to the patients, right? If you ever look at like an itemized hospital bill, it's like, one Tylenol, $40. So it's not as though they're not able to pass those costs along, which sucks for the end consumer, but consumption of healthcare, especially a hospital stay is usually not optional. People aren't, for the most part, they're not like deciding, oh, I want to spend a few days in the hospital. It's because of something that they needed. Now there are the fringe case thing of like there are elective procedures, sure, but a lot of the times that kind of comes out of your pocket anyway. Like insurance isn't really covering that, and the people who can pay for electives are oftentimes a little bit better off, and so like like a 10% increase in the cost of the procedure won't dissuade someone. Like Jeff Bezos's new lady friend, right? I don't know, did he marry her? But if she wants to go get like another, like a little adjustment done to like her nose or whatever, does she care if it costs an extra 10%? Probably not. So, yeah, interesting. Yeah. So it's just one of the things. And then, what'll end up happening is they'll have to renegotiate reimbursements with insurers who then will raise premiums. And that's where most people will really see the impact to their like bottom line as far as like what they take home from their work, et cetera. Because for most people, the biggest cost is the insurance premiums, and that just comes directly out of your paycheck from your employer in most cases. So yeah, that's where people will mostly see the impact from anything with regards to tariffs causing an increased cost to operators, etc. I think the exposure for MPT is minimal there. I don't think it's likely. It's not as severe as what happened in COVID, where hospitals were like legit overrun, and then elective procedures, which are money makers, even if they're not like the majority of what they do have better margins. Those were all put on hold. And then wage inflation hit, and basically like the cost of like nurses, doctors, admin staff, etc. went up faster than they could increase the reimbursement rates from insurance, Medicare, Medicaid. And because those reimbursement levels didn't increase by as much as the costs, that's why Steward collapsed. Basically, it was built on kind of a house of cards. They didn't have cushion because of like their balance sheet sucked and everything else. So yeah, I might do a separate like summary thing, like maybe like somewhere between like 5 and 10 minutes, covering the results and everything for anybody that didn't either missed it or doesn't have the time to go back and watch like an almost hour-long thing. Although really there's just not a whole lot worth scrutinizing on this one, seemingly compared to previous ones. I guess if the earnings calls are getting less exciting, it's a good thing, because I think people that buy a REIT like this, they want just a boring business that pays them a dividend and stores its value well. Yeah. I think most people that want to get into a REIT, they want a boring stock, right? So maybe the more boring, the better. Although the short interest, I believe, is still quite high. But I think to see a real substantial increase in share price, I think we need to see them to be like, oh yeah, we're going to start increasing that dividend again. I think if they say that they're able to increase the dividend, that signals the financial strength that they keep talking about. Like it's sort of putting your money where your mouth is in a literal sense on that. And also people buy things like this for the yield, right? Because you get a better yield on this than you will on most like bonds and things like that. And so you want it to feel like safe yield. And since we've recently had dividend cuts, maybe it doesn't feel like very safe yield at this point in time until they start raising it again. And then that kind of assuages fears in a lot of cases. A recently raised dividend always feels safer than a recently cut dividend. So yeah, I'm gonna wrap up pretty soon here. My Discord, I think, is linked in the description. Also, hey, if you're looking at maybe switching brokerages or trying out new ones, Moomoo linked in the platform. Use my link. You get some free stocks with it when you deposit. They've got good margin rates, though. I don't necessarily think people should be using margin with the market being this volatile and such recently. But hey, short levels on the company right now. I think it's right around 200 million shares at the moment. So like 35-ish% of the stock is. I think that's the last number I saw. It goes up and down, obviously, every time. So it may not be exact, and it's always a lag measure on the short interest. Well, so the 2.5 billion in debt that they recently did, the secured financing, in order to pay off near-term debt and whatnot. So basically, that pushes a lot of their debt out to 2032, I believe, is what that pushed it out to. So yeah, there's now, I would say, like a bit more cushion time wise on debt maturity. So yeah, and the thing is, there was a bit of a debt cliff here in 2025, 26, and 27. And that was sort of one of the big bear cases is, oh, hey, they're going to hit this debt cliff and not going to be able to get more notes to refinance or to push it out or to repay. And they're going to just have to sell all their assets at 50% discounts and go bankrupt. That was kind of what like Rob Simone was saying, which, by the way, he deleted his Twitter and ran away like a little, you know what. So, and he was the one that promised that this was going to zero. He promised it was going to zero. I don't see that now. I don't see that there's any, and which is why, of course, he deleted his Twitter in what I can only imagine is a bunch of shame. And Viceroy also, since the lawsuit between them and Medical Properties Trust got settled, they haven't really said a word either. That was probably one of the conditions, is they're not allowed to talk about, they're not allowed to badmouth Ed Aldag and MPT anymore. So yeah, so basically the people on social media that were big and public, it's going to zero, it's a fraud, blah blah blah, they are all mysteriously absent now, yet a massive chunk of the stock is still sold short by people who I could assume they were convinced by what they were seeing. I've always been very skeptical of, obviously, the short cases. It's just it always seemed hyperbolic. Now, I've definitely been like maybe in some instances overly optimistic on what the actual value was, and certainly, you know, I would have a lower entry price on the stock if I had been more correct, maybe more skeptical of the optimism. But what I found from the short side was anything that came out, any news, no, even if it was like objectively a good development for MPT, like the Utah joint venture where they got like a huge chunk of cash at valuations that were way higher than the balance sheet value of those facilities. They spun that as some kind of a big negative of like, see, this is what we told you, they're going to zero. Yet it generated a ton of liquidity and it demonstrated a substantial value over and above what those properties were listed for on their balance sheet, which is a good thing if you have to leverage your assets for liquidity. You want to get the maximum valuation you can, and that's whether you're doing financing or if you're selling or whatever. So the idea that could be spun as a negative, that was basically, even though I had an inkling, it was kind of the proof that the short side of it, they were just not being honest. Like it's just straight spin and intellectual dishonesty. Versus the long side, there are people that are like permabulls, and even when something isn't so good, they'll try to spin it of how it is actually good. But I have met a lot more people on the long side that were willing to acknowledge, like, oh, that was kind of a rough quarter. These results weren't what we wanted, especially during some of the steward type the things that were going on with steward, and even management on today's call when they reflected back on that. Yeah, a lot of stuff was not good that happened during the steward case. So yeah, I think assuming they get back to business as usual, hey, who knows? Maybe someday we'll see them back to all-time highs again. I just think it's probably gonna take time for the kind of like the overhang and the stigma to wear off. You have to remember that at one point this was like a $22 stock, something like that. I don't know if that's the all-time high, but it was somewhere in the 20s. It was at one point, and then at one point, at least intraday, fell to like 292 not very long ago. So that difference in price, like the fact that the stock could fall so far, that has kind of a lasting effect on people's perception of it. Most people, whether they'll admit it or not, are more affected by when they pull up like a chart for the last 5 years. If they see like a giant drop off, they're going to have a negative association with that and not be able to look past it in a lot of cases. Even though just buying the thing that's up the most in the last 5 years isn't really a smart strategy. People have a hard time buying something that sold out. They're like, the natural assumption is there is something fundamentally broken here, and there's no way that that this will ever recover. That's the thing that most people will think. So it takes a long time to erase that and turn around perception. PayPal suffers from that pretty badly. They print cash, right? They tons of free cash flow, tons of buybacks, but every time they start to kind of recover, there's always something that triggers it. Like people are just looking for a reason to sell off, especially anyone that maybe bought before this current price level. Maybe they bought it like $200 or something, and they're just looking to get back as much as they can. If it jumps to $90, they're like, well, I may not get another chance to get some of my money back. Well, anyway, guys, I appreciate you all tuning in, and yeah, I guess we'll do this again next quarter. Hopefully their predictions about all the different things with tenants paying and the ramp up of the steward replacements and everything goes right. It's funny to hear that steward is actually trying to literally steal from the new tenants. That's really classy. And $400 million they've paid in professional fees associated with their bankruptcy, which, like, hey guys, if you just spent that $400 million paying your bills, maybe you wouldn't be bankrupt. Okay, anyways, have a good one, everybody.